Hello. We're going to take a look at question 3 in the March-June 21 ACCA SBR exam. This was the question called Sitka, and the main company in this had a year ended of the 31st of December 07. If you haven't already, please pause the recording, read the question, plan out an answer before you start to follow through on what I'm saying in the recording. The first requirement, which again was about a software contract that the company was selling, and we were asked specifically again two things about that: whether it was a single performance obligation, I'm putting PO for performance obligation, and whether it was something you would recognise at a point in time or over time. Remember, there's two ways of recognising the revenue. And altogether, that was worth 8 marks. So you've read through the question. Will the examiner be impressed if you write out the 5-stage revenue recognition model? No, 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 no. The examiner will be depressed. He's told us which stages to talk about. Is it a single performance obligation or not? So I suppose that's sort of stage 2, but no one wants to know. And when you recognise point in time or over time, I suppose that's from stage 5. But we do need more detailed knowledge. So the first question is, we're offering this thing, which is licensed to use the software with updates, and the client is paying for the updates. They don't always update them in the same way as sometimes we're just too busy to update on a specific day, but they're buying it again as a package. So the first issue is about the performance obligations. And in particular, the key thing is that you need to identify what you see as a performance obligation. Keywords from IFRS 15 are that it's something that is separately identifiable, and so this is knowledge, not me making it up. And again, it's a separately identifiable thing from which the customer would gain a separate amount of benefit. In the same way as if you bought a training course, you get the lectures and you get the books. So could you gain benefit from each of them independently? So it's where the customer can gain benefits from the performance, the individual performance obligation. So the answer is, the question is, well, is it a single performance obligation? It depends how you read it. So if you say it is, you'll be marked right. And if you say it's not, you'll be marked right, as long as you've used the scenario. The way the examiner has gone is to say that actually, if you didn't really have the updates, then, it wouldn't be a very good service. And therefore, you effectively have to, in substance, you have to buy the updates. It's just a fact of life. So this is what the examiner said, but it's not the only right answer. He suggested that the benefits would be significantly reduced without the updates. But there's nothing wrong with you saying that these things are sold on a standalone basis. It's fine. So both are okay. So he went down the line of saying it's a single performance obligation. If you decided that they were separate performance obligations, you would then say that they would need to allocate the price to those performance obligations. Are you supposed to do a calculation? Well, I don't think you can, and no, unless there's a reference to the word calculate. So the best thing is leave that aside somewhere unless they say do some calculating. They've just put some figures in for a bit of colour, I suppose. Secondly, again, is this recognised at a point in time or over time? And you know the thing that if I'm actually constructing an asset for you and then at the end you get the asset, that's probably at a point in time. If I'm providing a service like I sing you a song every day, that would probably be over time, wouldn't it? But we need a bit of knowledge. So notice again, every time what I'm trying to do, even though I don't separately demarcate it, is that I will show some knowledge and then I will show some application. So again, I'll kick off with my knowledge. The knowledge here, and again, it's one of those phrases from IFRS 15 that you probably would have learned, and that is, the question is, it's something on the lines of, does the customer simultaneously consume the benefits of performance over time in the same way as you would if you were singing to my song? I'm not sure there will be many benefits from that, but it's the same idea. So the issue is, so over time, you would recognize something over time if the customer, so this is from the standard again, simultaneously consumes, so it doesn't sound like me, does it? Because it's coming from the standard, the benefits of performance. So as I perform, you consume the benefits and go, lovely song, or in this case, lovely update. Now, therefore, I think we probably all agree on this bit, that therefore, again, it's likely to be, so here's the application. So the customer is using the software over time. So I think it's likely to be, again, something that's satisfied over time. So the effect is, therefore, that the 3 million that the customer pays us will not be booked right at the start. It will be booked again as the contract progresses. Because every day, I guess, the customer wakes up and says, I must go and play with that software. So it's likely to be over time. Again, so that's probably it. The revenue of 3 million, will be spread over the contract term, which I think is 4 years. So will be recognised in the profit and loss over 4 years. I know that the study materials often talk about the methods of recognition over time, output and input method. I'd have thought that was completely irrelevant. I don't think they want anything else there. So there we are, my first question on revenue. The second question, and do pause the tape if you've not had a chance to look at it already, is looking at the perspective now of the customer in the same scenario and saying, from the customer's perspective, what about this right to use the software? So they are paying some money. They've paid this 3 million. And in particular, it asks us to say, well, is it possible that this right to use the software is an intangible asset? Also, whether it might be a lease. We're not going to write much for this because this was only allocated 4 marks. As always, what do we do first? We put down some knowledge. So knowledge of intangible, definition. Please don't type in the exam an intangible asset is not tangible. That's like typing an apple is not a banana. So an intangible asset is something that is identifiable, either because it is separable, you can sell it on, which you can't, I'm sure here, or it gives legal contractual rights, and it's controlled. I think here this is a bit more up in the air than we would perhaps think. If I buy Windows software or hardware, whatever it's called again, for my machine, I guess only I can use that particular lump of software, if lump is the right word. I guess with this, you're just having access to some software for a period of time. It may not meet the definition of intangible. The examiner argued that you couldn't really restrict the use of other people using the same software. I suppose so. And therefore he argued that actually it's not an intangible. I think you could have an argument either way on that. As far as the lease goes, well, a lease is a right to control a specific asset, again, in return for consideration for a period of time. It includes phrase, doesn't it, like the right to direct the use of the asset. Now, I think that's very unlikely. I understand leasing a bus or something, or a bin lorry if you're the local authority and want to lease a lorry from a company to go and pick up the bins from all the customers' houses, dustbin lorry, refuse. I'm not sure that sounds like a lease. I don't think there's any right in this case to say this is the way in which it can be used. It does say, doesn't it, we have to access the software via the cloud. We have no rights we do not have any ownership rights. So I'd have thought probably it is therefore very unlikely to be a lease. Intangible, the jury's out a bit more. Examiner said it's not. It probably isn't, I think, if it's just through the cloud. So I use some basic accounting software which costs almost, well, whatever. I think I would just expense that through the profit and loss account. So he argued that it's unlikely to be an intangible, but it's not the conclusion that matters. It's the fact that if you turn up at the exam, you must be able to define intangible, you must be able to define lease, otherwise we're in a pickle. That's what you need to sort out. Now, if you need to, please pause before you listen to the next part about Part C, which is really a completely unrelated requirement to the question. You have to be careful about what the question is asking, because we can all see that it's like a scenario where you're going down from 60 to 15%. So it is about a disposal of something that might be a subsidiary, But either way, or whatever it happens to be, yes, it's going down from 60% to 15%. The 60% was a subsidiary. The 15%, again, is just regular shares. So it's just like a regular investment. Now, there's no such thing as trade investment anymore. If you've got a regular investment, you're in the world of financial instruments, and therefore it must be measured at fair value. You can make an irrevocable election to put future gains and losses through OCI, or you can not make the election if you don't want to and just treat it as fair value through profit and loss. But I think normally it would be the former. Normally, I think this would be subsidiary going down to fair value through OCI. That's what most companies would do. The key thing is they're not asking you about the group accounts. They're asking you about the accounting in the parent's financial statements. That's very important. It's worth 9 marks. Again, very generous there. But words that we can obviously, we first of all need, don't we, to deal with the disposal. Because the disposal again will take place, and then we'll have to worry about what happens after the disposal. So we think first about the disposal itself. When you dispose of it, you are therefore going to de-recognise it, aren't you? You're going to de-recognise what you had before. You perhaps remember that phrase from your notes. We've crossed the control threshold. And when you cross the control threshold and lose control, there'll be a profit or loss. The profit or loss will be in the P&L. It will not be in OCI. So that's where the client is wrong. It says in the question they want to put any gain or loss in OCI. That's just incorrect. After that, we need to calculate the profit. And in calculating the profit, we need to think about what we have now compared to what we have before. What we have now are the proceeds. And from the scenario, it says that we actually sold this investment for 10 million. Do we have anything else? Yes, we do. We also have this 15% investment. And you know that these little investments need to be carried at fair value. So the fair value of the 15% is given in the scenario as 3.5 million. Less. Now, if you were doing the group accounts, you'd compare that to the net assets plus the goodwill minus the NCI. This is just the parent's accounts. Any profit is proceeds less carrying amounts. You're just saying, well, at what figure was it carried in the parent's accounts? So less the carrying amount. So that's given. It says in the parent's accounts, they use equity accounting, which is a bit unusual, but it's allowed. Doesn't matter. What's the figure? The figure they're using again on that particular day, I think it says in the scenario, the carrying amount was 12. So the difference between the two, 1.5, is going to profit and loss. We then just need to touch, don't we, on what happens after disposal. So the other issue is, what happens after the disposal? Well, you will continue to measure at fair value. So every balance sheet date, it will be updated. As I said at the start, the chances are that you'll put changes, gains and losses in OCI if it's a long-term shareholding, and that's always umbilically linked with the word irrevocable election. You'll make your irrevocable election, which means you can't change your mind later, and that means that future gains and losses go to OCI. So clarifying, the loss on disposal must go to P&L. Nothing can change that. Any subsequent profits or losses, again, will go to OCI. When it's taken on, the investment has taken on its new little being, and basically, again, it's changed to a fair value at OCI investment, or at least that's the most likely thing that they've done. There we are. There's requirement C. If need be, have a look now, pause the recording again, and have a look at the last part of the question about some evaluation of some assets. Which I think is worth the last 4 marks in the question. And the question specifically asks us to think, doesn't it, about IFRS 13. So we're back in the world of IFRS 13 again. If you've defined it in another part question, do you need to do it again? Yes, you do. It's one of the most important standards of all. So I would get straight in there and say, okay, when we think about fair value, the same phrases as you've probably used in the group accounts question earlier. It's the price, isn't it, that would be received on sale, again, of the asset in an orderly transaction, same phrase, between market participants. And the other point is, remember that with assets, the general thing is that you need to think about the highest and best use. In this cases, there are 2 choices. It does go on about this a bit, doesn't it? So one possibility is the industry buyer. And the other is the investor community, or the financial investor. So how much would they actually pay in total? The industry buyer would pay 30 plus 200, that's 230. The financial investor, again, would pay 50 and 150, that's 200. So much of IFRS 13 is common sense. Well, you'd sell it to the industry buyer, wouldn't you? So again, we would use 230 as a valuation. Not a huge amount to say. Simple questions, some of these. Again, just making simple but very, very important points. And that's a review of question 3.